Hello, everyone, and welcome to The Upside. I'm Kyle Sharapita. Global stock markets in 2025 have been defined by a turbulent first half, marked by a tariff-driven crash, fueled by a recovery, fueled by trade deal optimism and strong corporate fundamentals. AI and tech innovation continue to drive growth, particularly in the US. Amid uncertainty, investors have moved towards gold as a safe haven, while European, US, and Canadian markets have all traded off being hotter or colder at different times of the year. Tom Stevenson, Investment Director at Fidelity International, joins us today to share what he is seeing from London. Tom, good afternoon. How are you?
Hi, Card. I'm very well. Thanks for having me on.
No, thank you for joining me today. Now, we'll get to markets in a sec. First off, you were in Canada this summer. You had a great vacation. You were telling me about this when we spoke back in July, that it was upcoming at the time. How was it? How'd you find Vancouver Island?
Yeah, I had a wonderful trip to your beautiful country. Yeah, as you say, I was over on Vancouver Island and made it all the way over to the Pacific coast. Tried to do a bit of surfing. It's more difficult than it looks. But
did you stay
yeah,
up at all? Did you get up and just stay up on the board at all?
I stayed up very briefly.
Yeah. And how is the food out there on Vancouver Island?
Yeah, fantastic. Yeah, some lovely seafood and yeah, just had a really, really good trip. Had a couple of weeks out there. It was great.
Oh, that's fantastic. Well, I'm glad you had a great summer, and I'm thankful that you're able to join us today. Let's get to the markets. I'd love for you, now we spoke, I think it was early July last time. So what have you been seeing, just to kind of recap Q3, paint a picture for us to start things off?
Yeah, absolutely. Well, you painted the picture there of a very interesting year in the markets. We had the market sort of peaked in about February. We then had all that tariff shock back in April, and the markets really fell pretty sharply by about 20% or more between February and April. Since April, we've had, what I would characterize as a pretty remarkable recovery in markets. Certainly in the US market, closest to those tariff issues, but really all around the world. Whether you've been investing in the UK or Europe, Japan, China, the US, all over the place, markets have done extraordinarily well. I mean, you look at somewhere like Japan, for example. Since April, the market is up by about 35%. That's the same story in the US. Europe and China maybe up more than 20%, a little but less than that in the UK, but overall, very strong markets.
Very interesting Q3.
Yeah, absolutely. I mean, a lot of that has come. Well, it was Q2 and Q3. Really, it's been more or less a straight line. Markets have just carried on rising for the last 6 months.
Wow. Now, I did want to talk to you about inflation and interest rates as well. Can we look at that for both Europe as a whole and England? Maybe let's start with inflation first. What are you seeing there?
Yes, well, actually, quite different stories. I mean, here in the UK, inflation is proving to be pretty sticky, a bit of a problem for policymakers. The Bank of England has a 2% target for inflation. And it is currently running at the last reading was 3.8%. It's expected to go to 4% next month in September. So it's running at roughly twice the Bank of England's target. Slightly different story over the channel in continental Europe, where the most recent inflation figure was a bit softer than expected at about 2%. So European inflation is bang in line with the European Central Bank's target. Here in the UK, it's quite a bit above target.
Okay, and now how does that play into the interest rate discussion? Because there were some announcements last week. We can touch on the Fed and the BOC in a moment, which both cut last week. Bank of England stayed at, I believe, 4%. How does that all play into each other?
Yes, well, I mean, it plays pretty much as you would expect it to play. The Bank of England's hands are slightly tied. It can't really cut interest rates as fast as maybe it would like to, because the UK economy is quite weak at the moment. And I think the Bank of England would probably like to cut interest rates a bit faster than it can. But while inflation is running at twice the target, it really feels unable to. So as you say, interest rates stayed at 4%. That makes the UK a bit of an outlier when it comes to both inflation and interest rates, because in Europe, the rest of Europe, As I say, inflation a bit softer than over here in the UK, and interest rates have already fallen. Interest rates in Europe have halved, basically from 4% to 2%. They're probably at about where they're going to end up. I think that move, the ECB, the European Central Bank, has been able to cut interest rates in a way that we haven't over here.
Is there anything else in the rate story that's something happening in Europe that maybe us in Canada haven't heard about?
No, I don't think so. I think that the European economy is a bit like here in the UK. It's struggling a bit. It's struggling a little bit with the whole tariff situation, and that has led to a softening in the inflation story, and that's feeding through to interest rates.
Okay. And what do you make of the recent cuts by both the Fed and the Bank of Canada?
Well, I think very very interesting, really. I mean, I think the rate cut in the US is particularly interesting because if you look at the labor market in the US, it's beginning to soften, but unemployment is still pretty low in the US. Inflation is slightly above target. But nothing like as far above target as it is here in the US. So I think there is a real question about how far interest rates can go from here. I think the market is anticipating quite a few cuts in interest rates. And I think the Fed is a bit more cautious than that. And so I think we'll probably end up somewhere in the middle, maybe one or two more rate cuts for the rest of this year in the US. And then I think we'll get another pause like we had for most of this year. And I think the Fed will just wait and see what's going on with the ongoing impact of tariffs and what impact that's having on the economy before they decide to cut any further.
Right. Okay. So we're getting some cuts from the Fed, and you mentioned off the top there record highs in the markets off of that the lows that we had in April, and gold is also at all-time highs. What do you make of all of that?
Well, it's in a way it's slightly curious because if you look at the sort of the major asset classes, so shares and bonds and commodities like gold, they're all telling sort of slightly different stories because bond yields are quite high in some cases, particularly with long bonds which mature in quite a few years hence. That's saying that markets are a little bit concerned about inflation, a little bit concerned about growth. Gold, as you say, is hitting new highs. That's typically a sign of slight anxiety amongst investors. They're slightly nervous about all the uncertainty that there is in the world, and we know there's lots of uncertainty in the world. But at the same time, stock markets are really riding high. I mean, they are very, very strong all around the world. And you sort of think, well, they can't all be true at the same time. So I wonder how this is going to resolve itself. But for the time being, it is how it is. Investors in the stock market are pretty confident. Investors in the other markets seem a bit more nervous, if you like.
So I know we're not one to make predictions, but where do you think things could go in the next few months? It is an interesting story to look at the different angles to it.
Well, it feels to me like if you look at the stock market, it feels to me like momentum is on the side of the markets at the moment. There are three main drivers of where the market is at the moment. Company earnings. Company earnings are pretty strong at the moment. We had second quarter earnings season was actually a bit better than expected. Quite soon, within the next few weeks, we'll have the third quarter earnings season, and expectations are that earnings will grow at about 7% year on year. Now, what tends to happen during a results season is that the expected growth rate actually rises because results come in a bit stronger than anticipated, and that pushes up the growth rate. So it's entirely plausible that we'll get another quarter of maybe 10% earnings growth. That's pretty strong. That's enabling the second key factor for markets, valuations, to push higher. Valuations are pretty strong, but they're not really stretched. It's not like some of the market booms that we've had in the past where valuations have really got very, very high and to a worrying level. So they are justified by earnings at the moment. And then the third element is what's happening with interest rates. And I think interest rates are going to come down for the rest of this year. So I think that, while it feels to me like this bull market has been going on for quite a long time, and that may be cause for, a bit of concern, a bit of caution with investors, at the moment, it feels like momentum is pretty strong in markets.
Right. Is there a certain region of the world where maybe that momentum is the strongest? You mentioned Japan as an example off the top, as someone who's recovered quite strong from those April lows. Is Japan a success story, or is there maybe another part of the world that's really strong right now?
Well, I mean, it is pretty much across the board, but Japan has been strong. The Chinese stock market has actually been very strong over the summer, and one of the drivers of that has actually been, one of the drivers of the U.S. stock market was the AI story, the technology story. That has actually been picked up in China, and really throughout the year, we've seen a lot of interest in Chinese innovation in technology, and in particular with regard to AI. So that is starting to look quite interesting. I think from an investor's perspective, it's a good time to be investing, because the growth is really across the board, and it's possible to have a nicely diversified portfolio while still seeing gains really in many different markets at the same time.
Oh, that's interesting. Now, just to follow up on that, I wanted to link this back to something we talked about in July. In that show, you're talking about the case for US versus the case for Europe. Are those still the two regions that we're sort of looking at in either or is it really expanding to those other parts of the world?
I think the story is really broadening out. I mean, back in the early part of the year, Europe was really the strongest market outside the US. And I think the main reason for that was that Europe for a very long time had been very out of favor. And I think there was an element of recovery. I think some of the people that I talk to in the markets now, they're saying, well, actually, a lot of that good news in Europe has now been priced in. And I think investors are looking further afield for their diversification. And that's why Asia, and in particular emerging markets in Asia, are really looking quite interesting. One of the benefits of a falling US dollar, and the US dollar has fallen by about 10% so far this year against other currencies, is that tends to spill over into good performance by emerging markets. Emerging markets often have debts denominated in the dollar. So if the dollar falls, the value of their debts is also diminished, and that's a good thing. And also, a falling dollar tends to help commodity prices, and commodities tend to be a big part of the overall earnings mix in emerging markets. So I think emerging markets also look quite interesting at the moment.
Is there a certain country, region, or maybe sector within emerging markets that's standing out to you right now?
Well, I mean, I mentioned China, and that does seem to be the most interesting place at the moment, particularly the technology side, because the consumer is still a bit weak in China, actually, but the technology side is really doing well. The other big emerging market is India, but India is one of the more highly valued, unusually for an Asian market. It's almost as highly valued as the US market. So I think China is the of those Asian markets, China is the more interesting.
Tom, do you pay much attention to the frontier markets, the emerging markets of the emerging markets at all?
Well, I mean, I keep an eye on them, and it's quite a changeable situation. Though, go back a couple of years, and people were talking very positively about Indonesia, for example. Okay. There's a lot more anxiety about Indonesia now. There's some sort of political discord in the country, and that's spilling over into the markets. Other markets which have done very well recently, within that sort of slightly more frontier area, Korea and Taiwan have done very well. That's really a technology related story. So I think there's a lot of spillover from this whole AI story, which has, of course, been a major driver of developed markets, but it's now spilling over into emerging markets as well.
Interesting. I love getting your perspectives on England, Europe, other parts of the world. What are you seeing and perhaps liking about Canada right now? Is anything standing out to you?
Well, I mean, Canada, I think, is facing up to this changing relationship with the US, as the rest of the world is, frankly. And I think the interesting thing for Canada is how it develops those links with countries like the UK. And I think that's potential for, there's a lot of potential there, which has maybe been forced on Canada, but I think it creates some opportunities.
Yeah, and it probably doesn't hurt that our prime minister was with the Bank of England at one point as well.
Absolutely.
Yeah.
It's a very close connection. Yeah.
Yeah. Maybe just to follow up on that, can you think of anything from his term there that maybe would aid in this relationship that's building between the two countries right now?
Well, I think that I think the Prime Minister did a fantastic job when he was over here at the Bank of England, and I think that he's held in very high regard for his the way in which he managed really a global crisis, but it was a particularly severe crisis here in the UK, just as it was in other countries. And he did a very good job of managing that really very difficult time in a very effective, calm way.
That's great. Now, just Tom, as we look to wrap up today, I was just curious, what is your outlook for the rest of the year? What are some of the big stories, themes that you're paying attention to as we move into Q4?
Well, I think the interesting thing is this balance between the very positive AI-related technology growth story, because clearly there is a lot of growth in the economy. It's being fueled also by lower interest rates and still continuing fiscal spending. So I think there is a strong growth story, and it's the question of how investors balance that with the high valuations that we're seeing, the fact that the bull market has been running now for quite a long time, and that the scale of the recovery from, certainly over the last 3 years, the scale of the recovery from the lows that we saw back in 2022 has really been very substantial. And I just think, it's going to be an interesting, I think the rest of this year is going to be an interesting dynamic between those two competing forces. There's good news. There's also things to be concerned about, and no one quite knows how it will pan out. But for the moment, as I say, the force is with investors, the momentum is strong, and I think while the music is playing, you have to get up and dance.
That's good. We appreciate your perspectives, Tom, and I'm very curious to see what happens next myself. Now, if a Canadian wants to hear from you more, where can they do that?
Yeah, sure. So I write and I broadcast here in the UK on Fidelity's UK website, so fidelity.co.uk. Lots of my material there. Also on LinkedIn, if you search for me under Tom Stevenson and Fidelity, you'll find me on LinkedIn. All of my content at the Daily Telegraph, where I write a weekly column, I post that on LinkedIn. So that's probably the best way of accessing that content from me.
That's great. Thank you, Tom. And I know you'll also be joining Fidelity Canada's Fidelity Connects show in a few weeks. So for investors on the upside here, we try to be a little bit lighter in our topics, and you'll be going a bit deeper with Pamela Ritchie in a few weeks. So we look forward to seeing you on there. And then that show will also be available as a video podcast for anyone who wants it. So Tom, final words. Thank you for joining us today. Any final message that you'd like to leave with Canadians today?
Well, I think the final message I'd make is, stick with it. This is a really interesting time to be investing in the markets, and good luck with your investments.
Thanks so much, Tom. Well, you have a fantastic rest of your day, and we'll catch up with you again shortly. Thank you.
Thank you, Carl.
And thank you all for watching today. The Upside webcast stream daily, so please keep an eye on your inbox to not miss your invitation to the next show. And if you haven't done so already, sign up for the Upside newsletter to not miss out. In addition to the live shows, new video podcasts are released daily, both The Upside and Fidelity Connects. So search Fidelity Canada on YouTube, Spotify, or Apple Podcasts for those. Thanks for watching today, and I hope you'll join us again on The Upside. I'm Kyle Sharapata. Thanks for listening to, or watching, Fidelity Canada's The Upside podcast. Subscribe on your podcast platform of choice so you don't miss an episode. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on LinkedIn, YouTube, Instagram, or X. We'll wrap things up today with a quick disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.